Pop quiz. What happens when the world's largest bank spends $22 billion buying something they've spent decades betting against? And what happens when that same purchase coincides with the US government suddenly declaring that very asset a matter of national security for the first time in American history? Now, add one more layer. China announces they're cutting off global access to this resource starting January 1st, 2026. This isn't a hypothetical scenario we're discussing. This is happening right now with silver, and the convergence of these three forces, happening simultaneously for the first time ever, has created what may be the most dramatic setup in modern financial markets. Let me show you something that should immediately grab your attention. Between June and October of 2025, JPMorgan Chase executed one of the most spectacular position reversals in commodity trading history. They closed their entire 200 million ounce short position, a bet that silver prices would fall, and simultaneously accumulated 750 million ounces of physical metal. Think about what that means for a moment. JPMorgan didn't just change their mind about silver's direction. They deployed $22 billion to acquire the largest single private stockpile of silver in modern history, while betting against it was no longer profitable. But here's where things get interesting. This wasn't just a trading decision driven by market sentiment or technical analysis. On November the 7th, 2025, the U.S. Department of Interior published something called the Critical Minerals List for 2025. Buried in that bureaucratic document was a designation that changed everything. Silver officially joined copper and uranium as a critical mineral for American national security. Now, you might be thinking this is just another government report gathering dust in Washington, but this particular designation unlocks something called Defense Production Act authority, the same legal framework our government uses to maintain the Strategic Petroleum Reserve, which stores 714 million barrels of oil for emergencies, can now be applied to silver. Washington suddenly has the legal power to fund domestic silver mining, mandate how our industries allocate their silver supplies, and build strategic reserves of the metal itself. Let that sink in for a second. Our government just gave itself the authority to compete with private industry for silver supplies. And JPMorgan apparently saw this coming months before the official announcement. Then came the third force, and this one has the potential to reshape global commodity flows in ways we haven't seen since the oil embargoes of the 1970s. On a Tuesday afternoon in late 2025, China's Ministry of Commerce published announcement 2025-number 68. The document established what they're calling state trading management for silver exports, and the implementation date is January 1st, 2026, less than 3 weeks away as we're recording this. Here's what that actually means on the ground. Any company wanting to export silver from China will need special licenses. But not just anyone can get these licenses. You need ISO certifications, a credit line of 200 million renminbi, that's about 28 million US dollars, and most critically, you need documented proof of silver export history from 2022 through 2024. In other words, if you weren't already exporting significant quantities of silver from China before these rules were announced, you're locked out of the market entirely. Think about the timing here. China controls somewhere between 60 and 70% of global silver supply through their refining operations, their mining output, and their recycling facilities. They're about to require state approval for every ounce that leaves their borders, just as industrial demand for silver hit record levels in 2025. AI data centers, solar panel installations, electric vehicle production. All of these technologies consumed 1.2 billion ounces of silver this year alone. And that demand isn't slowing down. Now, watch what happened when traders realized these export controls were actually coming. In October 2025, Chinese silver exports surged to 660 tons in a single month. That's not normal market activity, that's panic. Companies were frantically front-loading shipments, getting as much metal out of China as possible before the January 1st deadline, when those export licenses become mandatory. But the most revealing signal isn't what happened in China. It's what happened to silver prices themselves. In December 2025, silver touched $64 per ounce, an all-time high that represented more than a doubling of prices in a single year. And this price surge happened while something catastrophic was unfolding in the paper's silver markets. Let me explain what's happening at the COMEX exchange, because this is where the mathematics becomes absolutely critical. COMEX maintains two categories of silver inventory. There's eligible inventory, metal that's stored in their approved warehouses but isn't necessarily available for delivery. And there's registered inventory, metal that's actually available to satisfy delivery demands on futures contracts. Right now, COMEX registered inventory has collapsed to 15-year lows. We're talking about roughly 38 to 40 million ounces of physical silver available to back futures contracts. But here's the problem. The open interest in silver futures, the total number of contracts representing claims on physical metal, exceeds 244% of that available supply. Do the math with me here. If you have 100 ounces of physical silver, but you've written contracts promising delivery of 244 ounces, what happens when people start demanding actual metal instead of accepting cash settlements? This isn't a hypothetical stress test. This is the actual structure of our silver market right now. And remember, JPMorgan just closed their massive short position and accumulated 750 million ounces of physical metal. They're not betting on silver going down anymore. They're betting on a scenario where physical metal becomes impossible to obtain at any price. And $22 billion is apparently what they were willing to deploy to position for that outcome. Here's what you need to understand about the convergence we're watching. We've seen governments designate strategic commodities before. We've seen major banks reverse their positions in markets. We've seen export controls disrupt supply chains. But we have never, in modern financial history, seen all three of these forces activate simultaneously for the same commodity within a 90-day window. JPMorgan's traders aren't known for making emotional decisions or following trends. When they deploy $22 billion, it's because their proprietary models are showing them something the rest of the market hasn't fully priced in yet. When our government designates silver a critical mineral for the first time ever, it's because someone in Washington is looking at the same supply-demand mathematics and recognizing that our national security interests are at stake. And when China implements export controls, it's because they understand that whoever controls silver supplies in the coming years will have significant leverage over the technology and defense industries that depend on it. The price hitting $64 in December wasn't the climax of this story. It was the opening act. Because here's what almost nobody is discussing. We're about to enter a 90-day period where three critical dates arrive in rapid succession, each one representing a stress test that our current silver market structure simply cannot pass without breaking something fundamental. And JPMorgan apparently knows exactly what's coming, because you don't spend $22 billion accumulating physical metal unless you're absolutely certain that metal is about to become a lot more valuable, or a lot harder to obtain. Let me show you exactly what they know that most investors don't. Now, I know what some of you are thinking. This sounds like another conspiracy theory about silver manipulation and hidden forces controlling markets. So, let me be absolutely clear. Everything I'm about to show you is documented in official government publications, verified exchange data, and publicly observable institutional behavior. This isn't speculation. This is happening in plain sight, and the evidence is irrefutable. Let's start with that critical minerals designation, because the implications go far beyond what most financial media has reported. When the U.S. Department of Interior published the final 2025 critical minerals list, on November 7th, they weren't just adding silver to some academic roster of important resources. They activated a specific legal framework that fundamentally changes how our government can interact with silver markets. The designation unlocks Defense Production Act authority. This legislation, passed in 1950 during the Korean War, gives the president sweeping powers to ensure availability of critical resources for national defense and essential civilian needs. This is the same authority our government used to accelerate vaccine production during COVID, the same authority used to maintain the Strategic Petroleum Reserve with its 714 million barrels of oil stored in underground caverns. Here's what that means for silver, specifically. Our government can now provide direct funding and loan guarantees to domestic silver mining operations. They can mandate that industrial users allocate their silver supplies according to government priorities. Meaning, if you're a solar panel manufacturer or an electronics company, Washington can tell you who gets your silver first. And most importantly, they can build strategic reserves of physical silver, purchasing metal from the market just like they do with crude oil. But here's what makes this particularly explosive right now. According to the U.S. Geological Survey, American silver production has been declining for years, while our industrial consumption continues to accelerate. We're importing more silver than we're mining domestically. And most of those imports flow through supply chains that either originate in China or depend on Chinese refining capacity. So, when our government designates silver a critical mineral for the first time in history, they're recognizing supply chain vulnerability and claiming legal authority to secure domestic supplies. Now, let's examine what China announced, because this is where global supply dynamics become absolutely critical. China's Ministry of Commerce announcement, 2025-68, isn't some vague policy statement. It's a detailed regulatory framework that goes into effect in less than 3 weeks, and the requirements are specifically designed to restrict who can participate in silver exports. You need ISO certifications, you need a credit line of 200 million renminbi, about $28 million US. You need documented export history from 2022 through 2024. But here's the part that really matters. The announcement specifically states these controls will remain in place through 2027. This isn't a temporary measure responding to some short-term market condition. China is implementing a 3-year framework for state management of silver exports. What does state trading management actually mean in practice? Even if you meet all the licensing requirements, even if you have the certifications and the credit lines and the export history, China's government reserves the right to approve or deny your export applications based on their assessment of domestic needs and strategic priorities. They're giving themselves veto power over every significant silver shipment leaving their borders. And remember the numbers here. China doesn't just mine silver. They refine it, they recycle it, they process ore from other countries through their facilities. When you account for all of these activities, Chinese operations touch somewhere between 60 and 70% of global silver supply. That's not a minority share of some fragmented market. That's dominant control over a critical industrial input. The impact was immediately visible in October's export data, 660 tons in a single month. To put that in perspective, China's average monthly silver exports typically run around 400 to 450 tons. October represented a 40 to 50% spike above normal levels, and it happened because every trader, every industrial user, every company that depends on Chinese silver realized these export controls were actually coming and started frantically stockpiling before the January 1st deadline. But the most compelling evidence that something fundamental is breaking doesn't come from government announcements or export statistics. It comes from what happened in the actual silver markets during October to 2025, and this is where JPMorgan's position reversal becomes impossible to ignore. On October 8th, the London silver market experienced what traders are calling a freeze, a single order for 1,000 tons of silver. That's about 32 million ounces, caused the entire market to seize up. Now think about what that means. The London Bullion Market Association claims to have enormous inventories. Their whole business model is based on maintaining deep, liquid markets where large orders can be filled without disrupting prices. But a 1,000-ton order, which represents barely 4% of the silver inventory they claim to have, caused the market to freeze. Swiss refiner Metalor, one of the most respected names in precious metals, responded by withdrawing from silver trading entirely until January 2026. They literally told their clients they cannot source physical metal reliably right now. When a major refiner with decades of experience and established supply relationships says they can't reliably source metal, that's not a minor technical disruption. That's evidence that the physical silver they're supposed to be trading doesn't actually exist in the quantities claimed on paper. Now overlay what JPMorgan was doing during this exact period. Between June and October, they closed their 200 million ounce short position, a complete reversal of their entire silver strategy executed in 4 months, while simultaneously accumulating 750 million ounces of physical metal. You know what else happened during this period? Silver lease rates, the cost to borrow physical silver for short-term delivery, spiked to levels we haven't seen since the supply squeezes of 2020 and 2021. When lease rates spike, it means there's intense demand for physical metal that can't be satisfied from existing inventories. People are literally paying premium rates just to borrow silver for temporary delivery because buying it outright isn't fast enough or available enough to meet their needs. The U.S. Mint announced shortages of silver coins, not temporary delays. Actual shortages where they couldn't produce enough eagles and other bullion coins to meet demand, despite silver supposedly being readily available at $60 per ounce. See the pattern forming here? Every indicator that measures actual physical metal availability, lease rates, refiner behavior, mint production capacity, exchange delivery capabilities, is flashing red. Meanwhile, every indicator that measures paper silver markets, futures contracts, ETF claims, exchange inventory reports, is suggesting there's plenty of supply available. That divergence is what JPMorgan's models apparently identified months before most of the market caught on. When you can see that registered COMEX inventory is at 15-year lows, while open interest exceeds 244% of available metal, and when you know that the U.S. government is about to designate silver a critical mineral while China implements export controls, you don't need sophisticated algorithms to understand what's coming. You're looking at a mathematical impossibility that's about to collide with real-world demand. The paper markets have created claims on 244 ounces of silver for every 100 ounces that actually exists in deliverable form. Those paper contracts were sustainable as long as most traders accepted cash settlements instead of demanding physical delivery. But what happens when the U.S. government's Defense Production Act authority encourages domestic industries to secure physical supplies? What happens when China's export controls make it impossible to import metal to cover shortfalls? What happens when major banks like JPMorgan decide they want physical metal instead of paper promises? According to the Commodity Futures Trading Commission's own data, JPMorgan went from being the largest commercial short in silver to essentially neutral or long in a matter of months. The CFTC publishes this information in their Commitments of Traders reports, and the reversal is documented in black and white. They weren't making a speculative bet on higher prices. They were repositioning ahead of a structural change in how silver markets function. And here's what should terrify anyone still holding paper silver contracts. If JPMorgan's models indicated they needed to deploy $22 billion to acquire physical metal before these three forces converged, what does that tell you about what they expect to happen after January 1st when China's export controls activate? Because we're not talking about a normal supply-demand imbalance that resolves itself through modest price adjustments. We're talking about the simultaneous activation of government strategic stockpiling, export restrictions on 70% of global supply, and the potential collapse of fractional reserve, precious metals markets that have operated for decades on the assumption that physical delivery would remain the exception rather than the rule. The evidence isn't hidden. It's published in government registries, exchange data, and regulatory filings. The question isn't whether this is happening. The question is what happens next, when three critical dates arrive within 90 days, and the silver market faces stress tests it has never encountered before. Let me show you exactly when this convergence becomes unavoidable. We're talking about three specific dates within the next 90 days, each one representing a stress test that our current silver market structure cannot pass without something breaking. January 1st, 2026. China's export controls go live. Every company shipping silver out of China needs government approval. But here's what makes this date explosive. JPMorgan has to return 4,000 tons of leased silver to ICBC, the Industrial and Commercial Bank of China, in early January. They borrowed this metal from a Chinese state bank, and now they need to return roughly 128 million ounces, right as China locks down exports. How do you source 4,000 tons of physical silver when the country controlling 70% of global supply just implemented export controls? You can't. That's why JPMorgan accumulated 750 million ounces months ago. They didn't position for higher prices. They positioned for a scenario where physical metal becomes impossible to source. But watch what else happens on January 1st. The U.S. government's critical mineral designation becomes operational. Defense Production Act authority activates. Washington can now compete with private industry for silver supplies, fund domestic mining, mandate industrial allocation, and build strategic reserves. Think about the timing. China cuts off 70% of global supply. Our industries, electronics, solar, defense contractors, medical devices, suddenly face shortages. The Defense Production Act gives Washington power to secure supplies for national security. They're going to start buying, start stockpiling, doing exactly what JPMorgan did months earlier. This is the first stress test. January 1st, 2026. China's controls activate, JPMorgan's lease comes due, U.S. government authority goes live. The silver market has to prove it can source enough physical metal to satisfy all competing demands simultaneously. Now, move forward to March 2026. The first major COMEX delivery cycle of the new year arrives, and the mathematics become brutal. Registered COMEX inventory sits at roughly 38 to 40 million ounces, the actual physical silver backing delivery demands. But open interest represents claims on 244% of available supply. That's 98 million ounces of paper, claims backed by 40 million ounces of physical metal, a ratio of 2.4 to 1. Historically, this fractional reserve system worked because most traders accepted cash settlement. The COMEX operated with this leverage because actual delivery requests ran around 10 to 20% of open interest. But what happens if just 41% of contract holders demand delivery? 41% of 98 million ounces equals 40 million ounces, completely exhausting registered inventory, mathematical insolvency. This happens in March, 2 months after China locked down exports and the U.S. activated Defense Production Act authority. By March, industrial users will have experienced constrained supply chains. They'll have watched lease rates spike and refiners withdraw from markets. Do you think industrial users will accept cash settlement when they need physical silver for production? Do you think our government will encourage paper contracts when building strategic reserves? Do you think investors who watch JPMorgan deploy $22 billion will trust paper claims? The March delivery cycle isn't routine settlement. It's a referendum on whether paper-silver markets can function when everyone realizes physical delivery matters. Now, let's talk about price targets based on historical precedent and current supply mathematics. Conservative scenario, $100 to $150 by late 2026. Industrial demand consumed 1.2 billion ounces in 2025. Mine production runs around 800 million ounces annually. We already have a 400 million ounce structural deficit before government stockpiling begins. If China's controls reduce supply by 20%, while U.S. buying adds 10% to demand, you're looking at a 600 million ounce deficit. Historically, a 10% supply deficit drives prices up 30 to 50%. A 50% deficit means multiples of current prices, not percentage increases. Moderate scenario, $200 to $300 if COMEX experiences delivery failures, forcing cash settlements. We've seen exchange failures before. When the London Metal Exchange experienced a nickel squeeze in March 2022, prices spiked from $30,000 to over $100,000 per ton, before the LME canceled trades and halted the market. If COMEX faces similar crisis where they cannot satisfy delivery demands, they'll force cash settlements. When you have 2.4 paper claims for every physical ounce and people demand delivery, the clearing price could easily be 3 to 4 times current levels. Extreme scenario, $400 to $600 if paper markets break entirely. Silver hit $50 in 1980 during the Hunt brothers squeeze. But $50 in 1980, using consistent inflation methodology, not manipulated CPI, equals roughly $600 in today's purchasing power. And the Hunt brothers squeeze happened without these fundamental constraints. They didn't have the U.S. government designating silver critical. They didn't have China implementing export controls on 70% of supply. They didn't have a 244% paper-to-physical ratio. They didn't have industrial demand consuming 1.2 billion ounces annually for technologies that didn't exist in 1980. So, when JPMorgan deployed $22 billion at $60 to $65 per ounce, what do their models show them? Their traders have the same data, the same mathematics, the same government policy information. They're calculating probable outcomes based on three forces that have never converged before colliding within a 90-day window. Here's what you need to understand. This isn't a trade. This is a transformation of how silver markets function. For decades, paper markets set prices while physical delivery remained exceptional. But when governments compete for physical supplies, when export controls restrict 70% of production, when fractional reserve exchanges face delivery demands they cannot satisfy, the entire pricing mechanism breaks. We're watching the transition from paper-priced commodity to physical-priced strategic resource. That transition is happening now, compressed into a 90-day window where January brings China's controls and JPMorgan's lease deadline, and March brings the COMEX delivery reckoning. Think back to where we started. JPMorgan spent $22 billion buying something they spent decades betting against. The U.S. government designated silver a critical mineral for the first time in American history. China announced they're cutting off global access starting January 1st. These aren't random events. This is coordinated positioning ahead of a structural break in commodity markets. The question isn't whether silver prices are going higher. The mathematics guarantee that outcome when you have structural deficits, export controls, government stockpiling, and fractional reserve failure converging simultaneously. The question is whether you understand what's happening early enough to position for it. JPMorgan made their choice months ago. They deployed $22 billion because their models showed them something that justified that commitment. The evidence is published in government documents, exchange data, and regulatory filings. The dates are set. The forces are converging. What happens next isn't speculation, it's mathematics, and the countdown to January 1st is already underway.